Let us look at how stock splits impact stock price and shareholder value. How does stock split uh, impact stock price and shareholder value? When a company undertake the task of splitting its stocks, there's always an impact on the share price of the company as well as uh, shareholder value. So I want to take number one, introduction. Stock splits change the number of shares in circulation, but they don't directly, impact the overall value of the company or investors' total holding. The split does not change the value of the company, and it doesn't really affect uh, investors' total holdings in the company. However, they can have an indirect impact on the stock price as well as on shareholder value. Number two, what is a stock split? What is a stock split? A stock split occurs when a company issues additional shares to existing shareholders. For example, a split of 2-for-1. In a case of a split, of 2-for-1, shareholders receive one additional share for every share they own. While the price per share is half divided into two. So they may have additional number of shares, but the value of their holdings remain the same. So the overall value of the investment stays the same. Only the number of shares and the share price, are adjusted. Number three, how stock splits affect stock price. How stock splits affect stock price. So in this case, we consider price adjustments. Price adjustments. After a stock split, the share price decreases proportionately, proportionally to the split ratio. For example, in a 2-for-1 split, the price is halved, is divided into two. We also want to see the fact that there's no immediate change in value. No immediate change in value. The total value of your investment does not change. If you own, let's say, 100 shares, at $100, before a 2-for-1 split, you owned 200 shares this time around at $50 after the split, but your investment will still be what? Will still be, $1,000. So there's no change in the value of your investment. You only have increased number of shares. Let's take into consideration market perception. Market perception. The lower share price can make the stock seem more affordable to individual investors, possibly increasing demand and creating upward pressure on price. When the price is somewhat lowered, investors feel they are buying the shares at a discount. They pile into it, and that would cause the price to rise. And it might be a temporary event because the entire concept of share price rising should be key to the fundamentals of the company and not just on the acts of splitting the share price itself. Please like this video and subscribe to this channel. Number four, impact on shareholder value. We've considered, impact on stock price. We want to look at an impact on shareholder value. So under this particular, concept, we want to look at liquidity. Liquidity. A stock split can improve the stock's liquidity by making it more affordable for a broader range of investors, potentially increasing liquidity and trading volume. Let's see psychological impacts. Psychological impacts. The lower share price may attract new investors, which could drive up the price over time. However, this is based on the market perception, not any fundamental change in the company. The market simply perceives that a lower price is better. They tend to key in, they rush to buy. But the most important thing to be considered is the company's financial health, the company's fundamentals. So let's see, the fact that there's no dilution of ownership. There's no dilution of ownership. A stock split does not dilute shareholder ownership or alter the company's financials. The proportional ownership remains the same, even though the number of shares increases. So there's no share dilution because we don't really have doesn't really dilute the existing share, just that there's an increase in share outstanding. The total value remains the same, despite the fact that there's an increased number of shares. Number five, why companies perform stock split. Why companies perform stock split. Number one here is attracting investors. Attracting investors. When the company stocks becomes too high, it might limit the pool of potential investors. When the price is too high, it tends to scare away investors. People who are hunting for penny stocks who don't want to buy shares of companies that are perceived to be too high. So a split can make the share more affordable, broadening the markets and potentially attracting new buyers. People that would have otherwise go for fractional ownership can now afford to buy, a full unit of shares. So number two is it signals growth, signaling growth. A company might perform a stock split to signal confidence in the growth, prospects, in the growth prospect of the company, implying that the company stock has increased significantly in value, and it's expects continued growth. Then boosting market liquidity. Boosting market liquidity. More shares in circulation can increase trading volume, which can lead to smoother transaction and better price discovery. That is, you could very easily sell the shares, and you can equally, easily buy the shares. So it promotes, and of course, it boosts market liquidity.